Hey, and welcome back to Joshua Talks Money. Today we're going to talk about the Invesco Trust QQQ ETF. Now, I've mentioned this briefly on my video on exchange traded funds, but today we're going to do something different. We're going to dive in on the computer and kind of go through what makes this ETF so attractive. We'll look at historical returns, the composition of the holdings, and by the end of the video, I think you'll be more informed on why the QQQ ETF is just a monster in the exchange traded fund space. So without further ado, let's dive in. Okay, so we are on the Invesco QQQ website, and the simple summary is that this is tracking the NASDAQ 100. And what that means is this is the top 100 companies from the NASDAQ index. And so if you scroll down, you can look at some different things. It's pretty cool. They lay out the top 10 holdings. And these are some common names we've seen in other videos. Apple and Microsoft and Amazon. And they'll actually show you the allocation. And so something like this with Apple, this means for every $100 that's in this ETF of yours, about $11 is going into Apple. I like to think of it that way. All right, so if we jump down, we actually see what sectors the fund has allocations in. And we can see that IT is a big one, as we can tell from those top 10 holdings, about 50%. And communications, consumer discretionary. And so some of these, you may be wondering, okay, healthcare, what does that mean? They actually will show you if you click here. Here's some companies in the healthcare holdings from QQQ. Things like Moderna, many of you may know that company. Gilead Sciences, this is the company that brought remdesivir. That was the therapeutic early on in COVID-19. Regeneron, this is who's behind the monoclonal antibodies. And so it's kind of interesting to look at the companies that make up this ETF. Pepsi, Costco, names you're familiar with. And I want to pause there and just say, when I was starting out investing, this all felt like a big black box to me. And I wasn't sure if I put money in certain stocks or funds, I didn't even really know what that meant. And now I start to think, oh, this is me putting money spread across the companies that I use and I'm involved with every day of my life. That makes me feel a lot better. I'm already giving them plenty of money. Just think of Starbucks. But to invest and have ownership in the companies themselves, it's really, really cool. Okay, let's jump over to this prospectus document. And this kind of gives a summary of the fund and gives some performance information. And so I want to take a look at that. If we look at the performance percentage on average per year, over here in the 10-year return, this is 22%, which is pretty significant. That's why it's been such a popular ETF. And if you think about the holdings we just went over, then the reason why this has grown so significantly is because it was capturing some of those massive runs from companies like Apple and Amazon. And so, of course, you're going to see these big returns on average because it really capitalized on the growth of these massive companies. You can see a $10,000 investment back in 2011 would have grown basically to around $75,000. All right, so something that's really cool to do is we can backtest a QQQ investment and see how it would have performed since roughly around its inception. So if I were to go down here and do 2001, giving this thing 20 years, let's say the initial investment was $500. And then let's say we would contribute a fixed amount of $500 and we would do that monthly. I know the portfolio is rebalanced quarterly, I believe. And so we would take a look at all this. Let's put in our ticker symbol QQQ. There it is. And our portfolio is 100% allocated to that. When we run this little simulation here, we can see that over time this has grown significantly. In that 20 years, that would be around $1 million that investment had grown to. Let me try to do some quick math. So basically, if you put in $500 per month, every month for a year, that's $6,000 a year. This very much could have been in a Roth contribution, for example. And so we do that for 20 years. That's $120,000 invested. That would have grown to over $1 million. So nearly a 10x return on your capital over the last 20 years. It's pretty incredible. This tool also gives you kind of showing drawdowns over the cycles and years that there was some pullbacks. Clearly 2008 is here. But if you look at the performance, it's right in line with what their website has shown. The 10-year is at 22% return. And to put that in perspective of something like VTI that I'm a huge fan of, VTI's 10-year return, I believe, was around 14%. So we're talking about 8 percentage points higher in an average 10-year return. That's significant in terms of compounding and growth. But as our buddy Jack Bogle from Vanguard would say, and you see this on most disclaimers, past performance is not an indication of future success. So while QQQ has really crushed it because of these big tech names, that doesn't necessarily mean that it's going to just always be performing at levels we've seen historically. And you know, something I think about is, although the portfolio is rebalanced quarterly, if we go to something like this lists the top 50 companies back in 1955. And so when you look at some of the names on here, you'll see a common theme. This is a lot around, you know, energy and oil. You're not seeing Apple on this list, at least here. You're not seeing some of these businesses that have just dominated and have done so just recently. And what that means is the top performers of today are most likely not going to be the top performers of tomorrow. I think about companies like Amazon and Apple, and they do have a competitive advantage based on their investments in things like AI and their investments in technology that will help them remain relevant, but it's not guaranteed. And so it's something to think about. All right, and another big thing is the risk. You know, I saw another video on this topic, and they made the point that if you invested, let's say at the peak, right, back here in 2000, there was this big crash and drawdown. And let's just do the numbers here real quick. So let's say it's $109. It would have taken, let's see, somewhere over here. Yeah, what is that? 15 years to get back to that price. That's painful, man. I mean, can you imagine just sitting there for 15 years? That's a decent chunk of your life, and just being at a loss. Most people probably would have sold for a loss at that point. And so I think it's important, this kind of raises the issue of dollar cost averaging, something we've talked about before. But instead of putting your life savings in right here, it would be the approach of, hey, can I contribute monthly? Much like our simulation, can I contribute some amount per month or per week where I'm going to be buying here and here, and even in this crash, now I'm buying shares much cheaper, and I'm doing that all the way through this rally. And so when you've captured you know, shares through this, overall your average is going to be pretty nice, as opposed to perhaps your eggs in one basket at potentially the peak. Okay, one more thing to know about QQQ is the expense ratio. So we've talked about this in other videos. The expense ratio is something you want to look out for because it can eat into your money. This 0.2% is basically $2 per $1,000 invested. If we jump over to this tool, this is an expense ratio cost calculator. And so what I've done is plugged in the 0.2% QQQ expense ratio, and I compared that with something like the 0.03% expense ratio, which is offered by ETFs like VTI and VWO. And so if we just look at this kind of calculation, we can see that that's a significant difference in the cost, $14,000 difference over this 30-year timeline. If we were to try another scenario, let's say we have an annual contribution of something much higher. Let's say we're maxing out a 401k, for example, and let's say our returns are a bit higher. Let's go to 8%. All right, now we're looking at 70,000. I mean, that's pretty significant. Theoretically, I guess that if QQQ is performing much higher than a VTI over that 30 years, which is obviously very unknown, then those costs don't matter as much perhaps, but it's something you should be aware of, something I like to take a look at. All right, and so one more thing to know about QQQ. It's trading right now at about $374 per share. And I own this, I own actually quite a bit of QQQ. And I think the thing to understand is when we talk about VTI, that's 3,000 plus companies. And then VOO is 500 companies. And now QQQ is only 100. And what that means is it's more risk. There's less diversification. When one of those holdings has a huge explosive growth moment or a giant sell-off, because that's a bigger slice of this pie, and the pie is smaller, you're going to feel that. And so it's important to consider that when you're investing. That's why I do own QQQ and I do own some of the broader index funds, because I want a little bit of both without too much exposure to that risk. Okay, so hey, if this was a helpful video, I would love if you consider subscribing. On this channel, we talk about everything from personal finance, investing, taxes, retirement, and I'm really sharing a lot of the things that I'm learning in real time about money. Also, drop me a comment. I would love to engage with you. I respond to everyone. So if you want to share some of your thoughts on this ETF or others, let's have a conversation, and I'm looking forward to it. Until next time, we'll talk to you soon.